All right. Happy Monday, everybody. If you can designate it as such. I'm Alex Varner here at Main Management, our head of research, alongside.
James Maxwell, VP of Research.
So we have a little bit of a different note today. We put together this piece that's going to go out to our clients, and it's kind of just give some perspective on the recent action we've had in the market. We did briefly touch down 20% peak to trough on the S&P 500 this morning, and then we had a rally and then a retreat.
Reversal and back and forth, back and forth.
Lots of data being priced in as we speak.
Yep.
But kind of our perspective around this is down 20% doesn't feel any good for anybody. Nobody likes it. It's clearly on the tariff talk, tariff chatter, trying to figure out what the levels are going to be. And I think the hard part is for now, we still don't know. I saw a headline saying that Europe was coming to the table.
Yep.
Other countries have started to talk. So hopefully that is a potential for an upside surprise.
Yeah.
But again, then you have headlines that, Trump's looking at putting another 50% on China, and that nobody likes that. So I think you've got kind of both sides going at each other here.
It was a little discouraging over the weekend not seeing a ton of positive headlines. I think that was one thing that the market was looking for that is kind of lacking. Shows the willingness of this administration to really take it even further than anyone thought.
Yeah. I think that's a big part of it is people are very surprised by so far the kind of unwavering nature, despite what's happening in the markets.
Yep.
That the administration is holding the line and okay with, as
Pain.
as we heard, take the medicine, I think is the term Trump's used. So for some perspective, there's a lot of people are saying sell now. We're going into a recession. There have been dozens, hundreds of reasons to sell throughout the years. If you look in the market, there is almost always a reason to sell. So this isn't new in that perspective in our mind. You did see the VIX spike last week. It got up above 45. I think it might have even hit 50 today. This is Monday, April 7th that we're recording. But basically going forward, these kind of VIX spikes and also a comparison with the Fear and Greed Index, CNN, those are kind of daily pieces. And so we've looked at forward returns, and generally they have historically presented good buying opportunities when you get spikes in the VIX or drops in the CNN Fear and Greed. That CNN Fear and Greed hit 4 on Friday, which is the lowest. We've been tracking it here daily since 2021. So that's below the bear market of 22. The lowest has been in 3 years here, almost 4 years. So these kind of, in historical perspective, have represented buying opportunities for people who have capital to put to work. The drawdown has been very quick. I think people have discussed the timeline on that. That first kind of 10% move we had was quick, and now the last 3 days here, even 2, Thursday and Friday, were very, very fast.
Yep.
And part of that is information and data flow. I think that's important to remember as you're working with kind of structural forces like algorithms, the hedge funds, with their kind of dialed in and baked in trading rules that the computers go in and they sell on certain keywords. And that wasn't an issue even 10 years ago. So I think the speed, it's worth noting, but it's also worth keeping in mind that there are different things that can cause and exacerbate speed to increase here as far as the selling goes. And I think the selling also, when certain levels get breached, depending on who's selling what, more of rules come into play.
Yep.
And then more selling occurs.
Yep.
And I think that's
self-reinforcing kind of dynamic that, it's tough to time.
Yeah. And I think you see here, we've got the S&P 500 peak to trough drawdown by year. We're now at 20%. That's double the median of 10.6, which is kind of the long-term drawdown. But again, it's not hugely outsized. You can see there are many times when selling of this nature occurs. And so, it doesn't feel good. But again, it's not as if we're hugely out of line with history.
It's kind of every 3 to 4 years on average, maybe 2 to 3 years, you get these 15, 20, 25% drawdowns intra-year.
Yeah.
It certainly doesn't feel good, as you said, but it's one of those things you have to kind of take. It's the fee of playing the game, of being in the market.
Yeah. And we want to reiterate, it's time in the market. and not timing the market. And if you haven't sold and we're down 20, now is probably not the time to do so. I think we look a little bit further here. We've had kind of 24 bear markets in the last 100 years. 11 of those were recession affiliated and 13 were not. So kind of 50-50 almost, 11, 13, 12, 12. But basically, if we even if we do go into a recession here, the total return S&P on the S&P after a 20% drawdown, which we have hit now, is 4% further down in the next 6 months. So basically, history tells us that even if we go into a recession from here, that's a big if. The bulk of the pain should be behind us.
Yes. Yeah. And kind of something we looked at internally here is the different types of bear markets. So this is borrowing from some of Goldman Sachs research, but we've looked at historical bear markets and kind of categorized them into different types. The big three that they identified were structural, event-driven, and cyclical. How you kind of define those is structural are these large bear markets that are triggered by financial bubbles or systemic imbalances, thinking like 2007, 2008, kind of these huge Great Depression-like events that really, really take years to develop and then actually grind through. You have these event-driven ones that are more one-off kind of shocks to the economy, shocks to the market, like 1987, like COVID. We think today is something like that. Then you have the more standard kind of cyclical bear markets where it's really just the economy as it's moving, rising rates. You have kind of the later stages of the economy where earnings start to fall, profits start to fall, and then you kind of have just a general shallow recession. Those are more standard, kind of like 2022. That was a little skewed by COVID, but more of just like a general standard cyclical rather than a structural issue or rather than some big shock. The overall takeaway is that if it is an event driven, those are the shortest kind of lasting and easiest to recover from, and have the strongest returns going out of. And you can generally think of that as because there is the ability for a policy response. And I think in this case, it's a similar, we think there's a similar dynamic where this is very much self-inflicted, where there is the administration wants tariffs for their reasons, whether those are justified or not, people can agree or disagree, but at the end of the day, they are putting these on because they want to. You could argue that maybe there's some deeper things at play that necessitate it, but I think overall, it's Trump and the administration can take the foot off the gas anytime they want. In that sense, it's very much event driven, where all it takes is kind of one easing, one negotiation, one policy response, and you kind of, in my guess, you'd see a reversal in some of these moves. It's not really structural, and it's not really cyclical. This is the cyclical kind of already happened in my view. Structural is kind of, I don't think there's the same imbalances.
You heard concerns around high valuations. And that was kind of it. But again, it was high valuations and earnings were still growing strong. So I think that, it's not like the financial crisis where we have to revamp the banking system and change the capital requirements. And people have three mortgages that they're leveraged onto homes that they, can't afford. Those imbalances don't appear, aren't related to this. This is, as James said, kind of self-inflicted in that it's a decision to put on tariffs. It's not something that has been forced by some imbalance in the economy.
Yeah, exactly. So kind of looking forward, you could say, oh, well, I think I'm going to go into a recession. I think we're going to go into a recession. And that means I must, I have to sell now. You saw on the chart on the previous page, even if there is a recession, the average kind of further drawdown over the next 6 months is down 4%. Again, recession may happen. It depends. It really, really depends on what the actual kind of timeline of events is. I don't think anyone wants a recession, so I would be betting on the kind of the case that there is not one. But of course, there's things can go wrong. So we'll see. But even if there is one, it's kind of like do you want to try to time the next 6 months and get that exactly right? It's going to be a difficult path over those next 6 months to actually get correct. We think that it's more important for the long term to kind of just stay batten down. Understand that over the next 1 year, 2 years, 3 years, most likely we'll be fine.
Yeah. I think and it's important to remember, even if we do go into a recession, since World War II, the average duration has just been 10 months.
Yep.
Not even it's 3/4, not even a full year. I think it's also worth mentioning that the last recession people really remember is the Great Financial Crisis. COVID was a very weird one-off. And I think people they look at COVID like, okay, that was a pandemic. That's different from an economic cyclical economic cycle recession. And the issue is that the GFC was really painful for a lot of people. And I think when they hear recession, they kind of jump back to that. And that's what they have in their mind as a recession. And I don't think that if we go into one this time, it's not going to be of similar depth or breadth. It's going to be more of, consumers are going to pull back. Their spending will slow because they're 70% of the economy. But it's because they're uncertain. It's not because they can't. It's not because they're having to sell a house and leave the keys in the door and walk away. It's because they're sitting on record cash and they go, well, I might need this for down the road a little bit. But it's not nearly the same kind of pressures and imbalances that were present in 07, 08.
Yep. So moving to the
market note here.
Moving to the market note, kind of our regularly scheduled content. We'll just hop in here with the kind of usuals of the week. First on market performance. I mean, it was all over the headlines. It's one of the largest 2-day drop in history in terms of the U.S. equities, but even across the board. Any thoughts on these?
You've seen, a clear defensive shift in the week. Staples, utilities, real estate, healthcare, kind of top performing sectors, and then infotech, energy was down almost 15%. Financials down, so definitely a more kind of defensive.
It's a risk off. The risk. I mean, it's kind of what you'd expect if the S&P drops 10% in a couple of days. On
the recession dashboard here, we made a couple of changes. Given the kind of uncertainty of what we're facing, we've put the consumer from green to blue. We put sentiment from green to blue, and we put the PMIs from green to blue. Just kind of saying, hey, we're looking forward. We are uncertain as to where this goes. We're going to look at the data. And I think, there's less green on there was before, but that's no surprise given what we've seen.
Yeah. One thing on the sentiment, something we've talked about a lot. Obviously there's been some readings that have been absolutely depressed in the past couple of months. Things like trade uncertainty and even, small business sentiment spiked up after the Trump election, and then kind of has come back down a bit here. It's one of those things. It's like you want to be positive on it going forward, just because sentiment's kind of this cyclical thing where when it's down, it's most likely to go up. When it's up, it's most likely to go down. But it's so uncertain here that I think we're just kind of leaving it at blue.
Yeah. So moving in, we had Liberation Day on April 2nd. You saw the tariff numbers with that little the board he had up, and it's everybody was kind of trying to figure out what are these percentages. These aren't actual tariff that are being levied on. It was a trade balance basically that the U.S. has with these countries, and they took that trade balance on a percent basis and cut it in half. And that's the U.S. tariffs that we were putting on. And they did this indiscriminately. They did it from I think Mexico and Canada were the two that were kind of excluded, given that we have a much closer relationship with them. But the 10% base, there is a 10% base rate that seems far less likely to be negotiated, and it's the incremental ones above that. And I think the reason for that is they're trying to correct and account for these tax cuts that they're hoping to extend. And that's a reason that 10% base is on there and kind of firmly in place. And then anything beyond that is potentially open to negotiation. China, we kind of put in its own bucket as it was already at 20% and now faces an additional 34%. And there's headlines today that Trump is jawboning about another 50. Who knows? But basically, you can see here that the Trump trade war has resulted in the effective tariff rate being, the highest level in over 100 years. Everybody's like to talk about Smoot-Hawley is the last one. I saw a joke somewhere that somebody said they have to do these every 100 years to make sure everybody who remembers how they didn't work is dead. So we shall see how this goes. The market response, as we mentioned, was kind of indiscriminate selling. It's a strong correlate. You look at The Russell 2000 selling off just as much as the NASDAQ. Those are very different compositions. The Russell 2000 is small caps, which have more domestic exposure. So the fact that markets are just selling across the board, not looking at where your revenues are coming from, that implies a kind of a strong risk-off sentiment. And you can see that within sectors, the defensive positioning, as we mentioned, where utilities and staples outperformed. We had economists coming on the tape basically saying, we're writing down our growth forecast, we're increasing our odds of a recession, we are increasing our inflation forecasts. So again, we'll see how those bear out, but people are definitely shifting to a more pessimistic, bearish view.
Yeah, I think one thing out there, and you saw this in the previous charts we had, which there's plenty of reasons to sell right now. I think it's kind of hard not to find a reason to sell. That's why sentiment's so poor. That's why the market's down 20% from peak to trough, is because it's very easy to find a reason to not like equities in this environment. I think the important thing is, it's times like these when you have to kind of look at the reasons to not sell, the reasons to buy. What can go actually right in this scenario? Everyone's pricing what can go wrong. Everyone's talking about what can go wrong. That's the consensus. As investors, you want to have a contrarian bone in you. You want to think about, okay, what can go right in this environment, whether that's, maybe negotiations to the upside, whatever it is out there, Fed response. There's things out there that can go right. I think it's those that you have to focus on.
Yeah, I would agree with that. As we got the trade balance last week. That's kind of what kicked this all off. You can see we've had a huge trade deficit, and it narrowed slightly. But again, imports and exports, you saw kind of imports inch lower, exports moved up to a new all-time high. But basically, the trade numbers are chugging along. This is also past data, so we will see how this changes. It'll be interesting to see how and if this picture changes as these tariffs come into play. A big part also, there was a ton of gold imports that occurred. Trying to get ahead of tariffs as people were importing physical gold, and that skewed some of the trade numbers earlier this year. So again, this is more, it's past. We'll wait and see what happens here.
It's almost like a COVID-like event where you get all these skewed economic data where, you can't really look at one piece, 1 month of release and look at that in isolation. You kind of have to see like, oh, this is why this is happening. People are importing gold because they don't want it to get, these millions and billions of dollars worth of gold to get tariffed. So these very exogenous events.
And then we had non-farm payrolls came in. Headline was well above forecast at 228,000. February was revised down a bit. Unemployment rate ticked up. Participation rate also ticked up, which is a good thing. Labor force grew. Wages were up kind of in line. They're up 3.8 on a year-over-year basis. But that's pretty high level. It was a kind of as she goes employment report. We saw confirmation. This is the participation rates. One thing worth noting is the 25 to 50-year-old prime working age cohort has been declining, which is potentially an area of concern. When you have the overall labor force growing, it means other groups are stepping in, and you've really seen kind of younger groups kind of buoying or bolstering the overall participation rate.
I think this is a good point to talk about kind of Powell last week and where the Fed takes a role in all of this. I think there were a lot of headlines last week. Powell seems kind of not willing to step in yet in kind of previous huge market corrections, kind of these massive down days of back-to-back or back-to-back-to-back even, including today. You've typically seen some sort of Fed response because they've historically been associated with things like COVID or major kind of structural breaks in the system. You haven't really seen that this time around. I think that speaks to he's not too worried about the actual economy. He has some inflation worries on the back of tariffs. We aren't, so we don't agree with that a lot.
We also have yet to see what those effects might be.
I think he's taking his time. The Fed as a whole is taking their time in this sort of environment, which makes sense. They're not, they're reactive, not proactive. But I think that it's out there. If something does break, they are a backstop. Rates are at 4.5%. They have room to cut.
We saw kind of the first week of the month was heavy on the employment data. We saw Challenger grade job cuts come in. Those surged to the third highest monthly reading ever.
Yeah.
That's on Doge and it's government efficiency, and 80% of those cuts were in the government sector. These are also worth saying these are announcements. They're not actual cuts that have occurred.
Yep.
So they are announcements and stand to, it's not guaranteed that you get a 1-for-1 cut per announcement here. But basically, the government cuts are responsible for the bulk of them here. You saw JOLTS, the Job Opening and Labor Turnover Survey. That's it's always delayed. It's like a month behind. You get like February, 2 days before March's non-farm payrolls. But basically, this kind of shows, again, is confirmed by the non-farm payrolls, where it's labor market's kind of steady, continuing to chug along. Yeah, we'll see. And then, you also had the ADP figure, which came in above forecasts. And it's nice to see here the black bars on this chart are small businesses, which are the bulk of payrolls. Small and medium are 70% of the total payrolls, and small alone is 44%. So it's good to see those firms hiring. And that means, to us, that's indicative of the main kind of driver of the employment is for now continuing to chug along.
Yep.
Let's see. And then this is kind of the summary here, Liberation Day followed by a market sell-off. This week we get inflation numbers, CPI, PPI. We get the NFIB small business optimism, and then you get a preliminary Michigan consumer sentiment reading on Friday.
And who knows what else will come out on the headlines on tariffs. I think we're all hoping for positive news, but it is to be seen.
Yeah, we shall see. In the wake of the market action today, we hope you're still at your desk,
staying calm.
Yeah. And that's it for the week.
Yep.
Thank you.
Thank you.